Welcome everyone to this webinar, Share Investing in Uncertain Times. My name's Sam Wylie, you know that already. So you'll also know that I have been running a webinar series for investors for the last 5 years. The last year I haven't run quite as many webinars as previously. What can I say? I've been busy. But in 2025, I intend to run another webinar on artificial intelligence for investors, a further webinar on India versus China, and of course this webinar, Share Investing in Uncertain Times. So what's the uncertainty? Well, it's the uncertainty of President Trump's radical economic agenda and also the uncertainty to do with the emergence of AI, and especially just whether the US market in particular is significantly overvalued. So let's jump into it. So here are our slides. We'll send you a copy of these slides in a day or two after this webinar. Now, what are we going to cover? Well, we're going to work down from strategy. It's always good to reattach to strategy. And we're going to look at strategic asset allocation, how much of your wealth is allocated across the different asset classes of shares and property and defensive assets and private assets like venture capital and infrastructure and private equity. We'll look at the difference between allocation and exposure and our different share classes. Now, we want to consider whether the US market is significantly overvalued and the Australian market as well, but we're especially concerned about overvaluation in the US market at the moment. And we're going to use these classic ratios: price to earnings ratio, cyclically adjusted price to earnings ratio, cash flow multiple, GDP multiple. But those ratios can only really take us so far. And so we're going to go deeper by imposing some structure on our thinking. And what will come out of that is what assumptions are critical to and underlie the current very high level of the US market. And what we'll see is an assumption about cash flow growth and also about real interest rates. Now, it's kind of obvious that these things are related to valuation, but we'll see, what you have to believe about cash flow growth into the future to justify the current level. And the same about real interest rates. And this is to do with quantitative tightening, quantitative easing, and the potential for the return of powerful deflationary forces. So we'll get into that. And then we'll also look at some other factors that might be driving us towards a recession and the likelihood that we could go into recession. And then we want to think about how should you position yourself. So what should you do if you're already fully invested in US shares? Now, I'm going to encourage you in this webinar to have a large exposure to US shares, and we'll go through some reasons for that. But I'm really long-term very bullish about the US market. I'm less bullish about the Aussie market, and we'll talk about those reasons as well. But what to do if you are already fully invested in the US market, but you're worried that we might be heading into recession. And what to do if you are underinvested or completely out of the US market going forward. And what we're going to find in that case is that you should be sequencing back into the market to get fully invested. You don't want to stay out of the market for too long. And you should also be preparing for the opportunity that a big fall in the market would present to you. If you're out of the US market, a big fall in the market would present an opportunity to get rapidly back into the market. And we'll talk about the possibility of avoiding the Magnificent Seven tech stocks. And then we'll go to some questions after about an hour. You can ask me anything as long as it's about finance. I'll be able to say something intelligent, otherwise nothing. And we'll also look at my finance education for investors course a bit as we go along. Now, let me just say, please don't sort of don't post any questions yet. Put your questions into the chat and we'll talk about them at the end of the session. I can only think about one thing at a time running this webinar. And I can't look at your questions as well. I'll answer all of your questions once we get to the end of the webinar. Okay, a little bit about me. Not too much because it's not very interesting. I went to the University of Western Australia and studied engineering. That's where I met my beautiful wife, Tracy. Tracy and I went to Canberra. She worked for the Prime Minister's Department, also worked for the federal government. I studied the master's degree of economics at the ANU, which you can see here. I got a scholarship from Solomon Brothers to go to the London Business School, which is the graduate business school of the University of London, where I did my PhD under Elroy Dempson, who'll come up a little bit later in the webinar. My PhD was on wealth management and asset management. After that, I went on the job market for PhD students, got a job as a junior professor at Dartmouth in the Tuck School of Business, stayed there for 7 years, and then we came home. We only meant to go to the US for 2 years, but it was so fabulous that we stayed for 7. Came home. I wanted to go to the Melbourne Business School because that's the best business school in Australia. And this is what the Melbourne Business School is going to look like once we raise enough money to build the new building. That's not what it looks like at the moment. You know that already. But I've been a principal fellow at the Melbourne Business School since 2004. So 21 years. The years definitely roll by. Okay, now I've always done an amount of consulting. Business school academics who don't talk to senior leadership of companies a lot and all the time don't really know what they're talking about. So I've always had a consulting business that got bigger over time. I've always done a lot of media. I haven't done quite as much recently because, as I said, I've been super busy. But this corporate consulting business has morphed into a wealth management consulting business. And so I have a business, Windlestone Education and Windlestone Consulting, actually two separate businesses. The education business runs the Finance Education for Investors course, which I'll talk about in a bit. And it's really for investors in this range, and also have a consulting business for investors in this range. So this turned into that. Anyway, as I said, not super interesting. Let's jump into this. Let's jump into talking about strategy. So here we have an example of strategic asset allocation. So the SAA, as it's called, is one of the 4 pillars of strategy. And it is determining how much of your wealth will be allocated to these different asset classes. We could break this into residential property and commercial property. And then we've got US shares, Aussie shares, global shares, private assets, which are infrastructure, private equity, venture capital, private credit, etc. And then defensive, meaning cash and bonds, etc. And here's a sort of representative asset allocation. This might not be the optimal asset allocation for you. That's the kind of thing we work out in my course, where we talk a lot about strategy and about different asset classes. But these add up to 100%, 100% of your investable wealth, which is typically your wealth outside the ownership of your home. Now, we also want to think about exposure. And you see that this adds up to 150%, not 100%. How can you have 150% of exposure? Well, you can borrow money. And you can see that we have a loan to valuation ratio of 2/3. And that means that we have, this is 25%, but our exposure to property is 75%, because for every dollar of our own money, we borrowed $2 from the bank. And now we have 150% exposure. And the way that we should think about this exposure, which we're interested in because we want to know, how risky are our investments, what could go right and what could go wrong. The way we should think about this is that if the value of our property went up 20%, 0.2, we multiply that by the exposure to see how much our wealth went up. So 0.2 times 75%, our wealth would go up by 15% if the value of property went up by 20%. And commensurately, it would go down as well if the value of property went down. But we're interested in exposure. And for many of you, you will have a lot more exposure to property than you have an allocation to property. So like I said, we're reconnecting to strategy here. Now, everyone needs to have an integrated strategy, integrated across these things. What are you going to invest in? That's what we were talking about just there. Which asset classes? And then even within the asset classes, what are you going to invest in? Once you decide to invest in residential property, within that asset class, you've got to decide, am I going to invest in apartments or in houses or in land, etc.? And then where to hold your assets. Am I going to hold it in superannuation? Am I going to have a self-managed super fund or an industry fund? Am I going to have a family trust where I'm going to hold my assets? Am I going to hold them directly, such as people do in negative gearing strategies? So where am I going to hold the assets, and what's my tax strategy going to be? Now, these things have to be integrated with each other. And then we need to integrate how much extra risk are we going to bring in? We talked about exposure just a moment ago, through leverage, through borrowing to invest. And how much are we going to take out through insurance or through hedging? Risk in and risk out. And then, of course, implementation. How are we actually going to bring the investments about? So once we decide that we're going to put 30% of our money into US shares, well, what do we do next? So are we going to buy the shares directly through a discount brokerage account? Are we going to do it through a super fund instead? Are we going to have a full service broker? Are we going to use exchange traded funds, managed funds? What are we going to do? How are we going to actually implement this decision? This is such a crucial thing. And, in my Finance Education for Investors course, a lot of the knowledge that you get about things like managed funds and exchange traded funds, etc., is so that you can implement properly. Now, these things have to be integrated. Let's just take an example of investing in shares. Say, for instance, that you decide that you're going to invest in Aussie shares and US shares. Well, where are you going to hold them? You might decide to hold most of the Aussie shares in your superannuation fund, because then the income will be protected from taxation, and hold the US shares in your family trust, for instance, because they will be taxed at a lower rate, because most of the return comes out as capital gains, and capital gains are taxed at a lower rate. But you need to make a decision about where you're going to hold them. You need to integrate these two things. And then you need to decide whether you're going to borrow any money to invest in shares. Now, most of you won't borrow to invest in shares. You'll borrow to invest in property. But some people borrow to invest in shares, and quite rationally. Now, if you decide to borrow to invest in shares, then that has an effect on implementation. It's a lot easier to borrow to invest directly in shares or into an exchange-traded funds than it is into managed funds. So these two things have to go together, and all of this has to go together. Your strategy has to be integrated. Unfortunately, most investors and most wealthy families do not have an integrated investment strategy, but it's a really crucial thing. And that's something that we really get into in my finance education for investors course, as I'll talk about in just a bit. But the point here is that the integration of strategies is absolutely crucial. But here we're talking about shares and asset allocation. It's good to start with strategy and work our way down. Okay, so why do we want to have a large allocation to shares? Because the return to shares has been terrific over time. Now, especially in Australia and the US. So here we're looking at the return, the total return on US shares and Australian shares over the last 125 years, from the beginning of 1900, the 1st of January 1900 to December the 31st, 2024. And this data is out of the Dimson Marsh Staunton database. Elroy was my thesis advisor at the London Business School. I'm sure he won't mind me borrowing his graph here. And this appears in the UBS Global Returns Investment Yearbook. And you can see these are real returns, which means that inflation has been taken out. And they're also, you can use this number to work out how much wealth actually grew. But after inflation has been taken out, 6.6%. And in Australia, even slightly more than that, more than 6.6% real return, which is terrific return. And so you can understand why people want to have large allocations to shares. What we're looking at here is what happened to a $1 investment in 1900. So if you invested $1 in 1900 into US shares, into a broad-based portfolio of US shares, and you reinvested the dividends and you didn't pay any tax, so these are before tax numbers, then your $1 grew to 2,911 after inflation. So these are real numbers. This is with inflation taken out. So this is real spending power, because inflation's already been accounted for. And this is more like $100,000 if we left inflation in. Now you can see that it's been even greater in Australia. Now the growth was faster in the first part of the 20th century in Australia, and faster in the US in the second part of the 20th century. And it's also true that the Aussie dollar fell against the US dollar. You can see here. So it's not really, once we account for the fact that US dollar appreciated against the Aussie dollar, we would find that this is slightly higher than that. Now it looks like stocks just go up with just a few wrinkles, but this is a log scale going up by factors of 10. So actually, these are very big falls. But the risk in stocks, as I really bring out in my course, is timing risk. It's the risk that you'll get in here and get out there, and that over 15 years you didn't get any return. Or that you'll get in here and you'll get out there, and over 20 years you didn't get any return. I mean, what you'd like to do is to get in here and get out there. But it's really about timing risk. The danger that you'll enter at a high point and leave at a low point. And the only real way to mitigate that risk, to manage that risk, is to be a long-term investor, to get into the market slowly, stay in for a long time, get out slowly. Investing in shares is for long-term investors, but the returns are fantastic for long-term investors. So we like large allocations. Now, what about US shares versus Aussie shares? Well, let's just think about tax. First of all, there's tax advantages to each. So the advantage in Australia is that we have dividend imputation in Australia. So attached to dividends are franking credits for corporate tax that's already been paid. And that's extremely helpful for tax residents like you and me, Aussie tax residents like you and me. Over half of the Australian stock market is owned by non-resident investors. Now, they don't get to use those franking credits, but they're still happy to buy Australian shares. So they could buy shares anywhere in the world And they buy all of those Australian shares, amongst, of course, trillions of dollars of other shares, but they buy half of the Australian stock market. And so tax residents like you and me in Australian shares are getting their return plus the extra gravy from the franking credits, from the reduction in the tax that we have to pay. So we get what global investors are happy with, and they could invest anywhere, what they're happy with, and we get something above that. And that's why, it makes that's a tax advantage for Australian tax residents, which is really significant and a significant reason for being invested in Aussie shares. What's the tax advantage in the US? Well, it is that most of the return on US shares comes in the form of capital gains. They don't pay large dividends, as we'll talk about in just a moment. And capital gains are taxed at a lower rate. We have we have the 50% capital gains discount for individuals in Australia. And so tax advantages for each. In Aussie shares, you get obviously Aussie dollar exposure. Many people will want to have less Aussie dollar exposure. Most likely your property is in Aussie dollars, almost certainly. And most of your assets and your earning capacity is in Aussie dollars. And you want to hedge against the fall in the Australian dollars, and foreign assets give you that. And that's a good reason for being invested in US shares. People are concerned with relative wealth. It's not really absolute wealth that affects how wealthy people feel. It's how wealthy they are relative to their neighbours. And if their neighbours' wealth is a lot of it's tied up in Aussie shares, then that's sort of the thing that they're comparing their wealth to. It's kind of in relative wealth terms, it's risky to invest in things that your neighbours don't invest in. The low risk thing to do if you're concerned with relative wealth rather than absolute wealth is to invest in a similar way to your neighbours. I know that sounds odd, but it actually has a significant effect. Now, in the US, you get, and in global shares in general, you get more diversification across sectors. Now, of course, in the US, especially because of the US tech dominance, you get tech exposure and exposure to AI. And this is a really crucial thing. But you get sector diversification in general. So you get diversification across not just mining and financials, which is principally what the Australian stock market is, but transport, agriculture, plenty of that in Australia, of course, but transport, manufacturing, pharmaceuticals, tech, etc. So much more diversification across different sectors. You really need to go outside Australia to achieve that. And then you get exposure to US economic dynamism. Look, the biggest mistake that investors made in aggregate in the 20th century, and they made lots of mistakes, and there's a lot of investors, obviously, but in aggregate, the biggest mistake that investors made is to be underweight the US market, the US stock market. That was the biggest mistake because the US market soared and the US dollar soared. And that really matters for non-US dollar investors like you and I, or Australian tax residents, depending on where you're watching this from. An example will bring this out. So in 1930, one British pound was worth $5. Now, one British pound's worth about $1.20, $1.23 or something like that. So there's been a 4-to-1 appreciation of the US dollar. So if you are a British investor in US shares, converting your pounds into US dollars to invest in the US stock markets, then not only did you get the returns from the soaring US stock markets, as we saw in that previous graph, but you got the 4-to-1 appreciation of the US dollar. So you got 4 times those soaring returns. It's really, look, and it's very likely, in my opinion, that the same mistake will be made by investors in the 21st century, that they'll be underweight US shares. So if you followed me through time in these webinars, you'll know that I'm very bullish about the US economy and about US tech dominance and about US economic dynamism. And so I always tell my clients and people who take my courses, I always advise them to have a significant allocation long-term to US equities. Don't make the mistake that people made in the 20th century. Now, I'm a bit bearish about the Aussie market over the next 5 to 10 years, and it's because of our low productivity. We're no more productive in Australia now than we were in 2016 per hour worked. We don't produce any more output than we did over 8 years ago. And I'm not making a political statement here. This is across both political parties who've been in power over the last 8 years. Productivity has been terrible, and it doesn't look like turning around. There's just a lack of political will, and we're heading for a hung parliament in Australia. There's a lack of political will to take the tough decisions that will increase our productivity. It's also true that China's economy is likely to slow a lot over time because of large structural problems in China's economy, which we'll talk about in another webinar. And Australia's economy is really hitched to the Chinese economy. But here's some considerations about Aussie shares and US shares. I'm always very bullish about US shares. I've become a bit bearish about Aussie shares. That doesn't mean moving my allocation down to zero, but it might mean me moving it from 20% down to something a bit lower than that. Okay, so are US shares overvalued? Let's have a look at some ratios here, some classic ratios. So here's the price to earnings ratio for the S&P 500. So these are approximately the 500 largest listed shares in the US, not exactly, but approximately the 500 largest. And we can see there's a price to earnings ratio of 20 here, which is more than the historical level of a little under 16. The average over the last 10 years has been 18.9, so it's not so much above that, but it is considerably above the historic level. Now, let me remind you what we mean by the price to earnings ratio. So it's the price of shares divided by their profits, their earnings per year. And here we are looking at the projected earnings into the future. Usually we're looking at the earnings over the previous year, but these are forward price to earnings ratios that we're looking here. And so because we've got price of the share on the top line in the numerator and the earnings, the profit on the bottom line, it represents how much we're prepared to pay today in the share per dollar of next year's earnings. How much are we prepared to pay today? $20 in this example per dollar of next year's earnings. And so that's averaged across the S&P 500 in that graph. Now, we're going to take the same graph into the next graph. So this blue line here appears in the next graph as this red line. You can see the 20 here. And we want to separate out the Magnificent 8 stocks, these stocks down here, including what used to be called Google, Amazon, Apple, and what used to be called Facebook, Microsoft, Netflix, NVIDIA, and Tesla. And so a lot of this very high valuation, or this high price to earnings ratio, is really being driven by this Magnificent 8. And we'll think a little bit later on about whether you might want to reduce your exposure to that. Now, once we get away from the largest shares, like the next 400 largest shares, these are typically shares where the total value of the shares in the company is worth more than 15 billion. These are 5 to 15 billion. This is 1 billion to 5 billion. And you can see that these mid and smaller shares, cap shares, they are not trading at higher multiples than their historical averages. Really, the valuation or overvaluation in the US, if there is one, is about the Magnificent 8. And so if you're really worried about overvaluation in the US and you want to reduce your exposure to the overvaluation, it's really this that you should be thinking about reducing your exposure to. Okay, let's look at a different version of the price to earnings ratio. This is the cyclically adjusted price to earnings ratio. This is Robert Shiller from Yale. He's a Nobel Prize winner. He didn't win the Nobel Prize for making this ratio. He won it for something more than that. But this simple ratio of the price of a share, not over 1 year's earnings, but over 10 years' earnings, because we're dividing by the average over 10 years and adjusting for inflation, averaging over 10 years is the cyclically adjusted part. Now, it gives us something more useful, and this is generally considered to be the best indicator of overvaluation of stocks. And you can see how high it is here. It's as high as it's ever been. This is the Great Depression, the Black Monday crash in the United States in 1929. This is the dot-com bubble. This is what happened after COVID, with the surge after COVID to peaking in December 2021. And then the decline after that as interest rates started to rise. So very high level by historical rates. And we'll look at why this has surged so much over the great bull run over the last 40 years. We'll come to that once we start to look at the underlying assumptions. But this is evidence that the US market is overvalued in these simple ratio terms. Another thing we could look at is the S&P 500 adjusted for inflation, in which case we'd see that peak, and we see that adjusted for inflation, we're not really above this previous peak, not really above the level of 4 years ago. That's an indication that the market is less overvalued than it was previously. This is as well with NASDAQ. Here, it's lower than its previous peak. But we shouldn't put too much into that. But it is helpful to look at the inflation adjusted because of NASDAQ and S&P 500, because we've had high levels of inflation over the last 3 or 4 years in the COVID era. Now, if we look at the CAPE ratio in Australia, we can see that it's not really much above historical levels. This is calculated in a slightly different way to the US, but that's not really the issue. The issue here is that the CAPE ratio is not at historically high levels. This is the run-up before the not the dot-com bubble, but the GFC. This is November of 2006, as opposed to the dot-com bubble, but not evidence of overvaluation in Australia. And look, and if we look at this, we can see again, we shouldn't be too concerned about overvaluation in Australia. So here I'm going back 20 years. Why did I choose 20 years? Because we don't want to choose something arbitrary. Let's just choose a big amount of time, 20 years back from today to March the 31st, 2005, 20 years ago. The S&P 500's at 1180. Well, now it's 4.8x 1180. And the ASX 300's at 4110. Now it's only 1.9 times what it was 20 years ago. And this is strong evidence that if one of these markets is overvalued, it's the US market. Now, it is true that more cash comes out as a percentage of the value of the shares. There's a strong impetus or incentive for Australian companies to pay more cash out, because the only way of getting franking credits, the tax credits, the corporate tax credits, but anyway, the only way to get valuable corporate credits into the hands of shareholders is to attach them to dividends. So you've got to pay large dividends in Australia if you have high earnings. And so that impetus means that a bit more cash gets paid out in Australia than in the US, the cash flow yield. And if you have more cash being paid out, you don't expect as much capital gain in Australia. But nonetheless, that doesn't explain most of this difference. Most of this difference is this huge run-up in the US. Now, another measure is the ratio of GDP to the total value of the US market, or I should say the US market to GDP ratio. So the value of shares in the S&P 500 is 209% of US GDP. This is about 30 trillion. So this is over 60 trillion. This is actually the whole of the market rather than just the S&P 500, I should say. You can see way back here in the 1970s, that number was below 50%. And now it's over 200%. And it's a measure of how much profits have soared in the US and also how much interest rates have come down. And people look at this, point at this and think that that represents evidence that the US market is overvalued. Warren Buffett makes that point. I'm not so convinced about that. I think it's just a permanent artifact of the US economy that the share markets are going to be worth a lot more as a percentage of GDP. Now, let's start to think about cash flows here. We're going to take this diagram forward with us and really go deeper on understanding whether the market is overvalued or not. This is going to be the start of us sort of unpacking the underlying assumptions or the assumptions that underpin the valuation of the market at the moment. And what we're going to look at is the cash coming out of the S&P 500. So what I'm thinking of here is treating the S&P 500 as if it was a single share, and it's paying cash out in two ways. One is the buying back of shares. So US companies buy back a lot of their own shares, and that is cash going out of the company and into the hands of shareholders, the shareholders who choose to sell their shares back to the company. But it's cash out of the company, 950 trillion per year at the moment. And dividends, and you can see here, dividends are much more stable than the buying back of shares, which is a bit more cyclical in the US. Companies do it when they've got more cash, but they try to keep the growth rate of their dividends very constant, even through COVID. 630 billion, 950 billion. In Australia, this number is hardly anything, and almost all of the cash comes out as dividends because of what I said before about attaching franking credits, corporate tax credits, dividend imputation credits to dividends. But in the US and in lots of places around the world, the companies like to pay the cash out as buybacks, because a buyback of shares gets the cash out of the company and into the hands of shareholders, but it puts the return in their hands as a capital gain. And capital gains is taxed at a lower rate in the United States, just as it is in Australia and just as it is in most countries. Some countries like Singapore don't have any capital gains tax. So buying back shares puts the money in the hands of the investors as a capital gain and a lower tax rate. In Australia, it's all dividends because of what I said about dividend imputation. But this is all cash out, I should say. And so we can add these two together to see the cash out per year, $1.58 trillion per year. Now, there's actually something we have to subtract here, because there's some cash going back in to the S&P 500. And we can see that down here, that there are secondary offerings. So this is the company raising capital by selling shares. That's cash going into the company. Preferred stock, IPOs, we should really leave this out because IPOs don't end up, these initial public offerings, these are companies listing on the stock market for the first time. It's very rare, it's only happened once or twice that companies have listed on the stock market and then gone straight into the S&P 500. They're usually too small for that. So we should really leave these dark bars out, but it doesn't really make any difference. We've got about 80 billion per year is money going back in to the S&P 500 by the issuance of new shares. So we've got to subtract that out. Buybacks, cash out, cash back in, 1.5 trillion. Now that's the money flowing out of the S&P 500, and the value of the shares in the S&P 500, 49.5 trillion. So the cash flow yield, 3%. 3% of the value of the S&P 500 coming out as cash flows per year. Now, if that sounds low, it is low by historical levels. This would ordinarily be more like 4%. And down here, we would have 25 times cash flows. That the value of the market, you see here, we have 33 times last year's cash flows. 33 multiple. Would you want to buy an asset where you're paying 33 times last year's cash flows? Well, only if you don't have good alternatives and you're expecting a lot of growth in cash flows. And that's where we're going. Now, just before we do go there, let me just run an ad here for my Finance Education for Investors course, which is coming up on the 1st of May. So the course runs over 10 weeks. It's 2 hours from 7 p.m. to 9 p.m. Eastern Standard Time on Thursday evenings. And it takes you through a guided process, week by week, 10 steps to get your investing in shape. So it teaches you everything that you need to know about investment classes like shares and property, residential property, and commercial property, and defensive assets and private assets like infrastructure and private equity and venture capital. Everything you need to know about different types of ways of investing, of implementing your investing, like managed funds and exchange traded funds, and all kinds of different tools. It teaches you about different types of advisors. Of course, you learn a lot about structuring and tax. You learn a lot about self-managed super funds and about family trusts and about corporations, etc. All of that. But the main part of the course, all of that is so that you can do something which is to get your investing right. So in a 10-step process, we take you week by week through a guided self-examination of your investing where you work out what's not working and you fix it. We start off in the first few weeks on goals and on risk, and then we work our way into strategy, into strategic asset allocation, structuring and tax, leverage, etc. We get everything right. It's very empowering, and it gets people to much better outcomes. People love the course. So it's everything you need. It's all the videos. It's a 10-step workbook for the 10-step process, all the pages. Most people will talk with me during the course, one-on-one. Next course starts on the 1st of May. It's over 10 Thursday nights. You can see them here. About half of the participants will come to the live Zoom sessions each week, and about half will watch the videos instead on demand at their leisure. And then about 30 to 40% of people will do both, come here and also watch them later on. Now, if you want more information, please go to windlestone.com to enroll or to get more information. Okay, thanks for letting me run that ad. So the next thing I want to do is to get to the underlying assumptions. I'm going to just simplify a little bit. I'm going to assume that these cash flows coming out of the S&P 500 are growing at a constant rate. Now, we can see that they're not growing at a constant rate. And most of the variation is in the buying back of shares. Companies do that when they're flush with cash. And they don't do it when they run into difficulty, like in the GFC, like in COVID. But they try to keep their dividends much more smooth here. But it's not a big deal to make this assumption. So we're going to assume that these cash flows are growing at a constant rate. And we're going to assume that the return that investors are demanding for investing in shares is constant from year to year. Now, I'm going to take these cash flows and they're going to appear in the next diagram. And the 49.5 million and 1.5 trillion are going to appear in the next diagram. Here it is. Here are those cash flows growing from 1.5 trillion over the last year. Let's take that as next year. And growing at a constant rate of G% per year. the growth in cash flows. We're going to use G to represent real cash flows in just a moment, but a constant growth in cash flows. And this is what the market's willing to pay for the S&P 500. What are the assumptions that underlie this willingness to pay such a large number and such a large multiple, this 33 times multiple? Well, willingness to pay is always driven by two things in finance. It's driven by the amount of cash, the quantity of cash, and the quality of the cash flows. And these things are all about the quality of the cash flows. And the first thing is investors demand, they require a return on their investment. They require at least what they could get for putting their money into government bonds. This is the yield on long-term government bonds, 30-year government bonds in the US case. Plus, they need something for risk. Plus, they need something for holding an illiquid asset. Now, it turns out the shares are very liquid, but some assets are quite illiquid, like commercial property or private equity, and venture capital is even more illiquid than that. And for the inconvenience of holding an illiquid asset, and for the cost of buying in and then selling out, the round trip cost of buying in and selling out on illiquid assets, they need extra return. So these three components, what you could get for putting your money in the safe government bonds or in the bank, plus something for taking the risk of investing in risky companies, plus something for your money being locked up. Those are the three essential components of investors' required return, the return that they demand. And this required return plus the expected amount of cash determines how much they're willing to pay. Now, I'm going to stack this up vertically in the next diagram. And here it is. We're going to see that this thing and this thing are the essential assumptions that we need to understand about what underwrites or underlies the very high valuation of the market at the moment, and work out whether that makes sense. But I'm going to stack these things up vertically. Here they are. So the required return of investors, looking forward into the future. What return are we expecting or requiring of our investment? First of all, there's the yield on government bonds. Then there's the market risk premium, the extra return that we need for investing in the stock market. And then there's something for asset illiquidity. Now, the shares are so liquid, especially large shares, and especially the S&P 500, the whole index, is incredibly liquid, that the really investors don't demand and they don't get anything for illiquidity. If we were talking about private equity, where your money's locked up for 10 years, this might be 2% or more. If we were talking about infrastructure, it might be 1 to 1.5%. If we were talking about commercial property, this might be 1% per year extra return for the difficulty of getting in and out of that asset class and for the inconvenience of your money being locked up. But for large shares and for big indexes like the S&P 500, and there's no bigger index in the world, $49 trillion of shares, that's incredibly liquid. Nothing there. Now, the required return can be thought of in a different way. This is what's driving the requirement of investors, but this is how they'll get their money, how the return will be realized. And it'll be realized in two ways. It'll be realized as a growth in the value of their investment, so a capital gain, and it'll be realized also as a yield, a cash flow yield, cash coming out every year, which we saw this was 3% for the S&P 500 just a moment ago. The cash flow, that was a 1.5 million over 49.5. Now, why do we say that the growth rate of cash flows and the growth rate of the shares is the same thing? Well, because we're assuming that the return is constant. There's only two things driving this. There's the return, the required return, and then the cash flows. And if we keep the required return constant, there's only one thing driving it, and that's the cash flows. And if the cash flows are growing at G% per year, then the value must be growing at G% per year. In our simple model, or a simple way of thinking about this, the value of the shares is going up at this constant G% per year. Now, these are simple assumptions, but a lot comes out of this, as we'll see. So we're going to think about what these different values are. But first of all, we're going to take out inflation on both sides, because inflation appears in both of these, so we may as well just take it out. It doesn't matter. Now these things become real return on long-term bonds, return on long-term bonds with inflation taken out, and real annual cash flow growth. the growth with inflation taken out. Now, we've got our market risk premium plus our real yield on government bonds, the required return being equal to the realized return in expectation values. This is what drives the size of the return, and this is just the way it's going to be delivered. And when we put these two things together, what we're going to find is that we know what some of these things are, and it's going to imply this. So we already know what this is. We know the cash flow yield is 3%. We saw that just a moment ago. This is 1.5 trillion divided by 49.5 trillion. So we know that that's 3%. And we saw that here. Here's our 3%. Now, we also have a pretty good estimate for this, for the market risk premium of 4.5%, the extra return that investors demand above long-term government bonds for holding shares. This is the expected return. What return they'll actually get, we don't know. But we do know that it'll be broken down when they get the return into cash flow yield plus capital gain. So 4.5% extra return over a long period of time, over 125 years, the real return on stocks above long-term government bonds. Now, in Dimson, Marsh and Staunton, these are 10-year bonds. And what we're interested in is 30-year bonds. And the real yield on 30-year bonds is higher than 10-year bonds. So I'm just going to adjust this. This is 2.1%. Just take my word for it that that's the right number. And so this is 4.5%, the average over a long period of time of the extra return over the yield on long-term bonds, the real yield on long-term bonds. And so 4.5%. Right at the moment, this yield, the real yield, the inflation, with inflation taken out, the required return of investors for holding 30-year government bonds, this is 2.3%. How do we know that? Because there are government bonds that are protected against inflation. How are they protected against inflation? Well, let's just talk about that another time. But they're called Treasury Inflation Protected Securities, TIPS. There's versions of this in Australia as well. They're called inflation index bonds in Australia. So you can see here, this is the yield that you get if you take inflation risk inside your, if what you get on your bonds, the interest payments on the bond and the value of the bond are not adjusted for inflation. But if they are adjusted for inflation, you get a lower yield with no inflation risk in here. So this is the real yield on government bonds. It's sort of, we think of it as a time value of money. It's not compensation for expected inflation because these are protected against expected inflation. It's the real yield, and they're 2.36. I used 2.3 here. I could have used 2.4, but you'll see in a moment why I used 2.3 instead. So now we've got three parts of our equation. And over here we've got 6.8, inflation plus 6.8. Remember we had inflation plus 6.6 earlier, so we're pretty close to that. Inflation plus 6.8. Over here, this must be 3.8 to make the equation work. It must be that the market is assuming that cash flows will grow at 3.8%. This is what we get from making those simple assumptions, imposing some structure onto the US stock market, making some simple assumptions. And there's only two assumptions: that the cash flows will grow at a constant rate into the future, and that the required return will be the same in every future year. And with those simple assumptions, we get out something that's really important. We're able to back out what people are thinking about real interest rates. And we'll see in a moment that really goes to their thinking about deflation and where the powerful deflationary forces are going to return. And just as important, or even more importantly, what they think is going to be the growth rate in real cash flows. You know, these are the things you have to believe in our simple model in order to get to those high valuations. It's very helpful to work backwards from market data to what the underlying assumptions are, so you can make a judgment for yourself about whether those underlying assumptions are realistic or not. And that's what we're going to do now. So here we are. We've got these underlying assumptions about the real interest rate and about the growth rate in cash flow. So let's just think, is it believable that cash flows could grow at 3.8% into the distant future? But because, you know, the problem is that the US economy only grows at 2.5% or 3%. You know, to get more than that, we'd have to have a big boom in productivity. That's not impossible. That happened in the 50s and 60s, and it could be driven by AI. But we should really be thinking this will be more like 2.5% real growth in the size of the economy. And if we're going to grow the cash flows coming out of the S&P 500 faster than the rate at which the economy is growing, then the proportion of the economy that is profits to companies or profits to shareholders has to go up. Now, that's happened already. Have a look at this graph. This is showing from 1948 to the present. It's showing the corporate profits, and this is not cash flows, but it's corporate profits, and cash flows are a percentage of that. Corporate profits after tax, ready to be paid out, as a percentage of nominal GDP. Now you can see that right up until the turn of the millennium, the years after the dot-com bubble and before the GFC, this is about 6%. After-tax profits of corporations are about 6% of GDP. And then after that period of time, it's about 10%. So the corporate profits as a percentage of GDP has gone up a lot in the US. Now, does that mean that this is a big transfer of wealth from working people to wealthy people? Well, there's an element of that. There's definitely an element of that. And you know, the populist vote for President Trump is an expression of that, or this is a cause of that sort of populist revolt that has brought President Trump back to power, and you know, similar leaders around the world. So there's an element of that, but it's also an expression of US companies making big profits overseas. And then the question comes, well, could the percentage of US profits as a percentage of US GDP and cash flows out of the S&P 500, could that go up over time? Let's think about it in terms of the global economy instead of the US economy. So the US economy is about $30 trillion a year in GDP. The global economy is about $130 trillion of GDP, between 120 and 130 trillion dollars of GDP. And so total US profits, 1.5, or total cash flows, I should say, coming out of the S&P 500, 1.5 trillion last year. That's what we saw, cash flows coming out of the S&P 500, 1.5 trillion as a fraction of total global GDP, 130 trillion, about 1.1%. Cash coming out of the S&P 500 into the hands of shareholders, 1.1% of global GDP. Could that grow to 2.2% of global GDP under the influence of US tech dominance and the growth of AI over the next 20 or 30 or 40 years? Could it grow to 3.3% or to 4% of global GDP? Well, I don't think it'll go that high, but could it grow to 2.2 to 3% of global GDP? Not only could that happen, I think that will happen. I think that is the most likely situation. The US tech dominance and the evolution of AI and a US economic dynamism will cause that, will cause US companies to make massive profits around the world and for that money to flow to those companies. And so far from that being fanciful, I think that's actually likely. So that underlying assumption about G here, I don't think that's unrealistic at all, quite frankly. Now, what about this assumption about whether this could go down or not? Because if this was to go down, if the required return of investors went down, then the value of the shares would go up. So if you don't require, holding cash flows constant, if you don't require as high a return, you're prepared to pay a higher price. Or it's saying it the other way around, it's more intuitive. If you demand a higher return, then you're prepared to pay a lower price. Your willingness to pay is lower if you're demanding a higher return. But if you will accept a lower return, you're willing to pay is higher. And you'll accepting a lower return can express itself here in this yield on long-term government bonds. Now, how should we think about that? Well, let's come down to this graph here. What you can see here is falling US Treasury bond yields from the 1980s when they were hugely high. I have a friend, David Pyle, I call him a friend, but I haven't seen him for quite a long time, but he told me 100 times that he bought the bond, the only bond issue that was ever above 15%. He bought it for his father-in-law way back in the day. But in any case, this has been down, 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 and this is a large part of the stock market going up, up, up. And actually, this trend over the best part of 40 years was one of the most powerful dynamic trends in all of global economics. And it came to an end. In COVID, we live in a new regime of higher interest rates. Now, these yields are both expected inflation and real interest rates. And if we want to just think about just the real interest rate component, this part, which is what appears in our model, then let's look at this graph. This is the real interest rate component of 30-year government bonds. Now, we've only had the TIPS bonds, the Treasury Inflation Protected bonds, since 2010. So the data doesn't go back beyond that. But there are other ways of looking at expected of real interest rates. But in any case, the key thing here is this difference between what's happened since the end of COVID. These real interest rates have been around 2.3. That's why I wrote 2.3 have averaged 2.3. That's why I wrote 2.3 into that slide. Whereas in the period between the GFC, this is more like the period after the sovereign debt crisis when Greece nearly tumbled out of the Eurozone. In the period, let's say, after the GFC and before COVID, in that period, a period where central banks are fighting powerful downward forces on prices. In that period, where interest rates in the US are cut close to zero by the Fed, and where there's 3 rounds of quantitative easing, pumping new money into the economy by buying bonds, the Fed buying bonds, that's what quantitative easing is, it pushed the real interest rate on these bonds, the Fed buying bonds, way down here as they're trying to fight deflationary forces, trying to stop the inflation rate in the US falling out the bottom of the Fed's range, which it did anyway. But they're really trying to stop inflation going negative, such as it is in China at the moment. And you can see that going into COVID, even before COVID struck, this was getting pretty dire, this fight against deflation. Now, a really critical question here, and what underwrites or underlies the high value of US stocks at the moment is this the new normal, a return to where we used to be pre-GFC, or are we going back to the pre-COVID level? Because if we go back to pre-COVID, let's just go back here, that number is going to be 1%. If we go back to a world where the Fed and ultimately the RBA and every central bank are fighting falling prices or fighting falling inflation, this goes back to 1%. And if this is 1%, that only has to be 2.5%. That only has to be equal to, for the current level of the stock market to make sense, that only has to be equal to expected long-term US growth. Nothing extraordinary at all. It's a combination of these two assumptions that underlies, that really is embodied in or embedded in the level of the S&P 500 at the moment. Now, I think both of these things are going to happen. I think we are going to have high growth rating cash flows of US companies because of US tech dominance, which is really very substantial. And we'll talk about that when we have a webinar on AI. But I also think we go back to a world where we are fighting deflation, where we are fighting downward forces on inflation. Now, not everyone agrees with that. There's people who are smarter than me, like Larry Summers and Charles Goodhart, who think that we're not going back to that we are permanently going to be in a world of high real interest rates and that we won't go back to quantitative easing. But there's people who are smarter than me who think we will, right? So there's people who are smarter than me, plenty of those people, on both sides, right? Now, I fall on the side that expects that we will go back to a world of fighting deflation. And what it really comes down to is how much emphasis you put on the deflationary pressure, the downward pressure on prices of new technology. If you think new technology is going to be very dominant in pushing down prices by expanding supply very quickly, then you're in my camp of believing that we go back to a world of low real interest rates. If you think that isn't the dominant thing, the dominant thing is demographics and the aging of populations. That's Charles Goodhart's hobby horse. Or that we're going to have a lot of demand for long-term capital to fund budget deficits, long-term capital to fund decarbonisation of the global economy, which is going to take $100 trillion, globalization for the AI build-out, long-term capital demand for the AI build-out, and for government deficits and for and for decarbonisation. Then you're in the Larry Summers camp. If you think it's going to be about ageing populations and about excessive demand for capital, higher interest rates. If you think it's going to be about emerging technology pushing down prices, then lower real interest rates. A world of low interest rates and quantitative easing. A world of higher interest rates over here. Investors need to make a choice about that. And you would have heard me talk about that a lot in previous webinars. My view is this goes down and that is realized. And that's why, that's a significant reason of why I'm not worried about the high level. As an investor who is fully invested in US shares, I'm not thinking, we could have a recession. I am thinking there could be a recession. But look, I'm not worried about it. I'm a long-term investor. I don't think that I can time the market. I don't think you can either. There's very little evidence that really anyone can time the market. Beta is the ability to move out of shares and into cash before the share market goes down, and out of cash and into the share market before the share market goes up, moving between asset classes. That's beta. Alpha is within the share market, choosing between stocks. Choosing Qantas instead of Virgin. I don't know if Virgin's IPO is coming. Rio instead of BHP, Coles instead of Woolworths, or Citigroup instead of Bank of America, Tesla instead of Nvidia. Like within the asset class of US shares or Aussie shares, choosing between stocks and making money by choosing the ones that are about to go up and getting rid of the ones, selling the ones that are about to go down. That's alpha. Now, there is evidence that some investors have alpha and can create value for themselves and for their clients by generating alpha. But there's very little evidence that investors can consistently create beta, time the market. It's the rarest thing. It's the rarest thing, the ability to time the market. And you don't have it, and I don't have it either. And so I'm not kidding myself. I'm fully invested in US shares. I'm bullish on the US. I'm not worried that there could be a recession and the market might go down in the short run. I think it's as likely as it goes down as that it goes up. I'm a long-term investor, getting in slowly, staying invested for a long time, getting out slowly, and not trying to time the market. Okay, I think both of these things will happen. That'll go down and that will be high. Not everyone agrees, of course. Okay, you can see that here. Now that is what's driven this up over the last 40 years. Cash flow growth in US companies has gone up a lot. We saw that before, and real interest rates have come down a lot over time. Nominal interest rates with inflation included, and real interest rates. But it's what supports, just to wind this up, what supports a high level of the S&P 500 is the belief that this is going to be large, but some combination of this and that, the belief that we are going back to a world of fighting deflation and quantitative easing. Now, let's have a look at some other considerations here, some more short-term considerations. Now, one is President Trump's radical agenda. So it's very radical. And I think there's only two things that will constrain President Trump's radical agenda. One is on the rule of law side, it'll be the Supreme Court. And I'm confident that will happen. President Trump is already pushing the limits in terms of what the courts will put up with. And the Supreme Court is going to have to stand up for the rule of law. I think they will. They are serious justices on the Supreme Court. And so I'm confident the Supreme Court will stand up and limit the pressure that President Trump puts on the courts. And the other thing is financial markets. Nobody can stand up to financial markets. No, it wouldn't matter if you were Caesar in Rome. Wouldn't matter if you were the king or queen in the British Empire. You cannot stand up to financial markets. And the reason is, when financial markets plunge, it creates panic in the economy. And the only way if that plunge in the financial markets is caused by your conduct as the leader, as the government, or as the executive, if it's your conduct, just think of what happened to Liz Truss, for instance, the British Prime Minister, who was only Prime Minister for 46 days. If it's your conduct that is causing the markets to go down, your refusal to reverse that conduct will put the economy into outright panic. And there's no bottom to the level of panic. That's why it doesn't matter what kind of political leader you are. You can't stand up to panic in the markets. And so this will put a constraint on the new administration's radical agenda. Here on the legal side, here on the market side. President Trump's going to push it to the very limit. And so there is, there is that increased probability of a recession because of President Trump's radical agenda pushing it to the limit. Look, I think there'll be some very healthy things for the economy from President Trump's radical agenda. He's going to make it easier for the AI build-out in the United States, just for instance. And that'll have a big positive effect on the economy, but he's going to push the limits. And these are the only things that are going to constrain it. And his tariffs are coming, and they're expected to be large, 10% of real tariffs. Not large compared to what we've had before the Second World War, but certainly large to what we've had recently. This was the increase in the first Trump administration of about 4% increase in tariffs. Now, another thing is that, and you might have seen me post this on LinkedIn, another thing is that we have had a lot of unwinding of quantitative easing. So this is the fighting of deflationary forces by creating new money. The first round of quantitative easing, the second round, the third round in the period between COVID and the GFC. And then, of course, a massive amount of quantitative easing, as much of all of this put together in just 8 weeks. A wall of money in the COVID crisis. Since then, the Fed has been unwinding. This is quantitative tightening. Now, this has gone a long way. This has gone very unnoticed in the press. People in the markets notice this, but in the press especially, how much has been unwound. Almost all of this has been unwound, and this will start to bite and put downward pressure on the market. This will put upward pressure on real interest rates in the same way that this put downward pressure on real interest rates. The market surged in each of these, all 4 of them. And eventually, with the withdrawal of liquidity from the economy, because quantitative tightening is the Federal Reserve and in the RBA in Australia not rolling over bonds that they own. The bonds that they bought in the market creating new money, when those bonds mature, they don't roll them over. If they don't roll them over, the money that went out with the buying of the bonds comes back in, the draining of liquidity from the market. And eventually, that will start to bite. Now, the Fed in the last meeting slowed down this process, and I think they'll continue to slow it down. But it's definitely something for us to watch. Another thing for us to watch is just the growth of US debt and the debt bomb that is ticking in the US. Look, I mean, this makes sense. It might have been excessive, this amount of spending by the Congress and by the Obama administration after the GFC, and here by the Trump administration and then the Biden administration in COVID. It might have been excessive, but at least it made sense. But here, you've got a healthy, growing economy and a 6.5% GDP budget deficit. That's ridiculous. This is complete loss of the will to fight debt, or the complete loss of fiscal probity. And that's a ticking time bomb. I don't worry about that too much. As a long-term bullish US investor, people say to me, Sam, aren't you worried about the ticking time bomb that is US debt, to sort of use my expression? Look, I think that'll blow up at some stage. And when it does blow up, it might represent an opportunity to go deeper on US debt shares, because I'm confident that the American institutions, the Congress, the administration, the US public will solve the problem. They're good at dealing with that kind of adversity in the US when faced with a national crisis. And I think they'll do that quite quickly. But it'll take a crisis to get it done. They won't have the political will until there's a big crisis. And that's coming one day. But I think it will pass. And as a very long-term investor, I don't sweat it too much. And I don't kid myself that I know when it's going to arrive. But it does arrive. I'll figure out a way to make money from the opportunity. But until then, I'm not going to worry about it. I'm confident that US institutions and the public will deal with the crisis when it comes. Okay, now, if we think that there is a higher than usual probability of a recession, what does that really mean? So let me just elaborate here. Goldman Sachs, for instance, the other day raised their probability of US recession from about 20%, which is normal in any year. There's a 20% probability that will go into recession in the US since the Second World War. They raised that from 20% to 35%. which is a near doubling. And so a much higher probability. And many other, like JP Morgan has a higher percentage than that. And you can see in the VIX index, which is a measure of volatility, the markets, look, the markets, if the market thought that we're heading to a recession for sure, then the market would go down instantly. And it has gone down 8.3% from its peak to reflect that. But from here, there has to be a feeling that there's kind of an equal probability of a fall or a rise in the market. But the size of the fall or the rise is larger. There's a greater expectation of extreme events. That's what the VIX index, the volatility index, is measuring. Okay, how should we think about that? Well, the way I think about it is, if you're fully invested, don't worry about it. You're a long-term investor. You can't time the market. It's as likely that you will regret getting out of the market before it went up as that you'll be happy that you got out before it went down. If you jump out of the market now, you're taking the risk that the market goes up and you can't get back in, right? So, and if you think the market can't go up a lot from here, you haven't been listening to what I've been saying over the last 20 minutes, or you've got a different point of view, I should say, to that. If you're a fully invested investor in US shares, don't worry about it and just stay the course. If you are out of the market, think about the market going down. If you got out of the US because of the US market in COVID or for some other reason, if you have got money, if you've inherited money, made money, saved money that you need to invest and you're underinvested in US shares, look at the potential fall in the US market as an opportunity to get fully invested. That's the way you should think about it. And we can see that here. The thing to do is to put in place some trigger points. So here's where the market peaked. Here's where we are today, March the 31st. And then put in place some trigger points of how much you're going to invest at each level. If you are out of the market and you're not fully invested by the time the market drops by 20%, then you're doing yourself a disservice. If you're thinking it has to drop by 30% before I'm going to go fully back in, you're kidding yourself, right? You're kidding yourself that you can pick the bottom of the market. You cannot pick the bottom of the market. Look, if you don't put these trigger points in place, what will happen is what happened in COVID. There's so many investors in COVID went into COVID holding cash, thinking if they weren't anticipating COVID, they were just thinking that at any point in time, there's a lot of investors who hold cash thinking, if the market tanks, I'll buy in at the lower price and then the market will recover. But what happens is the market goes down. In the panic of the moment, they can't pull the trigger, and then the market goes back up again and they haven't done anything. And that happened to a lot of investors in COVID who are holding cash. Now, to get around that, you've got to pre-commit that if these trigger points are reached, I'm going in. And that's that. Even in the panic of the moment, I'm going in because I'm happy to be fully invested by the time the market is 20% off its peak. Investors who've done that in the past have been very pleased with the results of buying in because, the market always exceeds its previous peak. We're talking about the Aussie market and the US market here. There's some emerging markets for which that won't be true. Put some trigger points in place. Be fully out of the market by the time it's dropped 20% from its peak. Be fully invested and pre-commit to hitting those trigger points. If you're out of the market, you need to sequence back into the market anyway. Absent the market going down, you need to put some money in. In this example, we're putting 1/12 every quarter back into the market. You're fully out of the market. You're someone who's fully out of the market. You're going to sequence your way back in over the next 3 years, 1/12 every quarter. Because look, there's two risks here. There's the risk that you jump in 100% today and the market goes down, but there's the risk that you stay out of the market and the market goes up and you never get back in. So the only way to mitigate those risks is to get in slowly, get out slowly. So this choice is about whether you think the market is overvalued or not. If you think it's heavily overvalued, this will be a bigger number. If you think that it's not overvalued, this will be a smaller number. But if you're sequencing back into the market and then the market plunges, go all in. Take the opportunity to stop your sequencing and just get into the market. Okay, what do we got? Not having a large allocation to US shares is a bet against the 21st century being about tech, US tech dominance, the dynamism of the US economy. You do not want to make that bet. That's the mistake investors made in the 20th century. Are US shares overvalued? Will AI drive a big enough cash flow? Will G rise enough to justify the high valuations at the moment? I think it will. Or will the real interest rates fall? So investors will accept a lower return. I think that'll happen as well with a return of deflationary forces. Sam thinks both will happen. Sam's a bit bearish about the Aussie economy. The reason Sam's a bit bearish about the Aussie economy is because of our policy paralysis, which isn't going to get any better in the election when we come back with a hung parliament, and because there's really long-term significant structural problems in China, and our economy is hitched to the Chinese economy. That's the subject of another webinar coming up. Is the likelihood of a large fall in the S&P 500 higher now? Yes, it is, because of President Trump's radical agenda. But look, President Trump's radical agenda could send the market up as well as send it down. But the probability of a large fall is higher. We do have quantitative tightening. On average, since the Second World War, if the economy in the US goes into a recession, from peak to trough, 20% fall. That could happen. And if it does happen, then if you're out of the market, take that opportunity to become fully invested. If you're fully invested, don't sweat it. You're a long-term investor. It'll go back to higher peaks. You'll ride through it. Don't pretend that you can time the market. The people who over their investment journey try to time the market just spend too much time out of the market. That's what happens. They go out. It's as likely that it goes up after they went out as that they went down. It's as likely that they regret it it is that they're happy, because they don't have the capacity to time the market. They don't, I don't, you don't. And so they just get out of the market. They can't get back in, and they spend a lot of time out of the market, under-investing. That's a great way to earn low returns. Get fully invested, stay fully invested. Don't kid yourself that you can time the market. The higher likelihood that we're headed to a recession, it's an opportunity to get into the market. That higher likelihood that we're headed into a recession is matched by a higher likelihood that we're headed into a boom. If that wasn't true, the market would go down straight away. Okay, that's all of the key points in this webinar. Now we're going to head into some questions. But just before we do that, we should flash up one more look at my course. So, my course is a very practical thing. People get big returns on their capital, multiple times what they spend on it. By the way, if you're an alumnus, you can take the course for half this price. You can repeat the course if you're an alumnus for half price. You have all of the materials for 2 years anyway. But if you took the course a few years ago, if you took the course a few years ago, then come back and do it again for half price, and you'll have all the materials and access for 2 years. People get a big return on their investment in the course. But the course is a very practical thing. Some of the things we've been talking about here are sort of more of an understanding, I wouldn't say theoretical, but not as practical and nuts and bolts as the course is. Okay, I'm going to sign up for the video here for people who are just watching the video and go to questions. Thanks for coming to the webinar. See you at the next one.